We would love to be the ones that take someone's trash and turn it into treasure. When you see a deal at a price that's very attractive, you move. You move quickly. You lock it up because time kills all deals. I learned the world of workouts, and I learned the world of distressed office in New York City. I learned the world of disjointed capital stacks, and that gave me the perspective I have today.
Hello, everyone. My name is Jonathan Spitz, and I am the host of the Redirect podcast, and I'm joined by my colleague and co-host, Storm Murphy. And this podcast is brought to you by Lightstone Direct. Lightstone is a private equity real estate company that's been around for almost 40 years. With $12 billion in assets under management and a portfolio that spans over 25,000 apartment units and over 12 million square feet of industrial space, Lightstone is now offering individuals the ability to co-invest alongside Lightstone in the same individual investment opportunities that the firm is pursuing with its own capital.
On this podcast, we're going to be talking about all things investing and real estate, how deals are being underwritten, how risk is assessed, how value is created and preserved over time. The focus here is really going to be on the decisions, the execution, and the true thinking behind institutional real estate investing. We're hosting industry experts who are going to share similar and or differing perspectives that we have. So whether you're an active investor or just looking to better understand how experienced operators are allocating capital, the Redirect podcast is designed to give you a clearer view into where markets are and how to think about participating in them.
And with that, let's jump into today's episode.
Welcome, everybody. My name is Jonathan Spitz, and I lead the capital formation team here at Lightstone Direct. I am the host of the Redirect podcast. I'm joined by Sanford Blumenthal, who is our SVP, our Senior Vice President of Investments, and leads and shapes the direction of our investment strategy here at Lightstone. So appreciate you taking the time today, Sanford.
Of course, happy to do it.
Absolutely. So let's start. I'd love to just start with some background, right? So how'd you get into the real estate business? Because you graduated magna cum laude from Penn, and you were an international relations major. So real estate was not the original path. Is that right?
That's correct. Although, growing up, my father was a real estate investment banker, and he started his career into the late 1970s, well into the 80s when things were pretty nuts, right? And he was the guy that had that first cell phone. That was a car phone, the giant box with the big battery in the back, the brick. And just so happens that we would constantly go on ski trips, particularly early Saturday mornings up to Hunter Mountain and the Catskills. And I would hear him constantly doing deals. Must have cost $10 a minute back then on that phone.
Right.
I don't even know how those things worked. But that kind of piqued my interest, and I knew all the language, the nomenclature, players involved. Obviously, the market has changed quite a bit in the decades since, but it was a tangible thing to understand even as a kid. He would point to buildings when we went to the city. I financed this, I worked on that. I know this owner, I know that seller. And it always stuck with me.
So when did you graduate? What was the market like when you graduated?
2007. What an interesting time to come into the business world full time. I had many friends that went to Bear Stearns for their first job. And needless to say, the world fell apart right away, right? I think it was a true crash course for me in terms of learning how to adapt, learning what can happen. And then when you expect the worst to happen and the fail shoot fails as well, how bad can it get? It gave me real perspective about markets, about underwriting assumptions, about lava pits and how to avoid them in the future. And looking back on it at the time as a young professional, it was a little bit frustrating because people were kind of sitting on their hands not doing deals. But I learned the world of workouts, and I learned the world of distressed office in New York City. I learned the world of disjointed capital stacks. And that gave me the perspective I have today to give me that grounding and foundation to, hopefully learn from the past, not make those same mistakes. And then in turn, I think a big foundational part of my career during that era, particularly as we got into 2008 and 2009, was being able to spot relative value, right? And one of our tenets of investing here at Lightstone is when you see a deal at a price that is very attractive, you move. You move quickly. You lock it up you get the deal closed because time kills all deals, right? So that's our ethos. We make money on the buy, and we're very opportunistic when we see good relative value.
Yeah, I mean, I think that's been my biggest observation in being here over, the past 6 months and sitting in an investment committee with yourself and David and Mitch and the rest of the investment team is the speed in which we move and the level of conviction, but not sacrificing detail. So how do you balance those two, right? When you're trying to be fast and close quick or go non-refundable, making sure you do the proper amount of due diligence. How do you do that?
Yeah, it comes down to clear communication, process, and establishing written SOPs. A lot of it's muscle memory, but in the end of the day, because we're doing deals that have great risk-adjusted returns and good relative value on the front end when we buy, there's always a nuance to it, right? If these were cookie-cutter deals, plain vanilla, that are highly competitive with others where it doesn't require expertise or real operating leverage from our team or the great human capital we put together, it just wouldn't be a deal that we would do. We don't like plain vanilla, right? There's always a story. There's always an angle. Where we're quick is after the soft diligence period, right? The post-hard pre-closing period. That's where we beat our competitors because of our balance sheet, our lender relationships, our conviction, our ability to move on the fly, right? We bring that time in. We don't sacrifice on the DD periods, right? We need to cross every T, dot every I, make sure our third-party reports are coming in, review them thoroughly, and proceed with the transaction. And if we encounter turbulence along the way, clearly, some problems are solvable. So when we're presented with a problem on a deal, we are problem solvers. We don't just throw the deal away, right? We try to find a way to make it work. That could be a price adjustment. That could be a timing adjustment. That could be a structured deal with the seller holding paper. There's a multitude of paths to course correct if things go wrong. But, we pride ourselves on being highly diligent, moving very quickly. And I like to refer to us, frankly, as a well-oiled machine. That's the team we built.
Yeah. Obviously, you graduated in 2007. You were out in the professional world, and now you've seen what a down cycle looks like from 2007. Here we are, fast forward, 15, almost 20 years later. What, I guess, similarities and differences do you see from what it was like then versus kind of what we've been experiencing over the last several years?
Yeah, I mean, rules exist for a reason. Regulations exist for a reason. And with every calamity comes forward progress, right? The pitfalls at the systemic level, right? And those kind of loopholes or glaring or gaping holes in the regulations have largely closed up, right? So that frothiness and that irresponsible buying when you buy something for 100 cents on the dollar and the lender gives you 103 cents at the table and you're walking away with 3 cents and you own the deed, those days are done, right? That was the Wild West craziness back in the day before the GFC of the robo signing and the subprime crisis and all that stuff that went on. Those are largely corrected and the market matured. Underwriting standards became more stringent. So there is a natural balance to the force, as they say, with that regulatory progression. That being said, everything is in hindsight, right? When these things happen, you could poke holes on a Monday morning quarterback perspective. So, the way we look at the world today versus the world of yesteryear, it's really boiling it down to fundamentals. When we make a decision, it's not really about how much money we can make. It's about what conditions need to be in place for us to first and foremost break even. And then, God forbid there's a capital impairment. How bad can bad get? And we like to take the glass is half full approach when it comes time to actually wiring money and thinking through the deal as a fiduciary and really treating it as it's our own money, because the reality is it is.
I want to go back to 2020, 2021, right? Because one of the more interesting things I remember hearing when I first came to Lightstone was, at that time, especially across our industrial strategy, which you oversee, we were buying a lot in 2019, 2020, 2021, but we were also selling a lot.
Oh, yeah.
So, while a lot of people were kind of chasing the whole way up, what did you see at that point? Obviously, you were in investment committee and in a lot of those conversations, I think we sold over to almost $250 million in industrial at that point. What ultimately led to that decision? What did you see?
Yeah, I think part of investing is having the mindset to be very strict with your approach. You don't go out of bounds. You don't deviate from the plan. And part of that plan is the other angle of investing, right? Dispositions.
Yeah.
Being aware of when things seem too good to be true, right? If you're not a buyer at that price that,
Yeah.
your prospective buyers want to buy it at, well, then naturally you're a seller.
Mm.
It's having that maturity, having that ability to be greedy, right? But don't be too greedy.
Yeah.
Greed is good. Pigs get slaughtered.
Yeah.
So when we saw, a price that was outside of our 10-year hold period, and we've held something for 15 months,
Yeah.
we hit the sell button.
Yeah.
We don't regret it. We don't look back. We don't have seller's remorse, right? $1 earned in that situation is more than good enough. So we have a keen eye for when to buy, how to buy, and when to let go. And you fall in love with your wife, you fall in love with your kids, you fall in love with your passions outside of work. You don't fall in love with a deal.
Why do you think that is? It seems that seems common though, right? People do tend to they fall in love with deals. What do you think that is? Why do people get emotionally attached to these things?
Yeah, I think human nature dictates all, right? I think when people fall in love with a deal, they have regrets maybe in terms of the most precious commodity we have, time. They look at a calendar year. They look at the hours that they fill those days with, and they get emotionally attached. I mean, it's hard. It's hard to separate the two, but you need to know when to hold them, know when to fold them.
Do you have a story of maybe a deal that you had an emotional attachment to and how that worked out, good or bad?
Yeah. Outside of the industrial world, the hotel business, which we're very involved in, is a much more sexy business, right?
Yeah.
And I've had many deals that kind of fit that profile, but the ones I really fell in love with most, there's a reason why I did, right? When I say fall in love, I mean, I was into it, right?
Yeah.
I like the returns. I like the business plan. I say never fall in love with a deal, but when you're dealing with a hotel in the middle of Times Square, right? To launch a flagship brand for Marriott, which was Moxie, our 45 7th Avenue U.S. flagship that got the whole party started. That building was a match made in heaven for our company,
right?
For Marriott, for us. The building actually had the letter M all over it. Why? Because it was built by a copper magnate named Arthur Mills. So to me, it was almost like a sign from the real estate gods. Arthur Mills, M. Marriott, M. Moxie, M. Right? It all kind of came together. And that's a good story, right? That's one that I did fall in love with, and it did happen. But, there were times where, as a younger analyst, I would spend endless hours toiling away. And I think early on in my career, the GM building is a perfect example of one that kind of got away.
Where was that property located?
That's right here in Manhattan, off Central Park. They had this building where the Apple Store is, the big glass cube. At the time, in the thick of moment, during the chaos of the GFC, the company I was working for at the time, they couldn't get comfortable with the ground floor and subterranean retail, right? It was a newfound concept. But looking back on it, it would have increased the slug rate, right? That would have been a behemoth of a deal. The total dollars involved, the whole dollar profits would have been amazing. But I was younger then and naive, and I wasn't making the decisions, right?
Right. So I want to go back, to really, you were at the forefront of building our industrial platform, Lightstone.
Yeah.
What was that discussion like, building the platform from scratch? Or what are some of those decisions that enable you to get started?
Yeah. So kind of connecting the dots, and perfect segue from what we just kind of flowed into from the Moxie conversation. We were sitting with quite a bit of development, right? Thousands of keys in the ground, pretty much all at the same time. And we had an aha moment. Development with that kind of ramp up, you have zero cash flow for those development months. And we're scratching our heads. Hey, how do we find high yield, to balance for that 0% yield during these development periods. And at the time, kind of in the 2019 run up into the COVID era, industrial was trading at high single digit cap rates. So with that, we actually went out and hired a few analysts, and we were very specifically focused on industrial resume, and deal flow in their history. And that provided us some of the backbone. And obviously we flexed our broker relationships, read every white paper imaginable, really ingrained ourselves like in deep study for this new vertical. And we were very clever about it in that our first couple deals were actually sale leasebacks. The one thing that people don't take full stock of when they're underwriting industrial is that very rarely do you have just a box, right? There's a living, breathing, operating business in these buildings. There's office, there's bathrooms, there's other components. Sometimes there's second floor mezzanine office. And the market has a negative perception of office space as a percentage of the totality of the overall warehouse or industrial building footage. So we were keenly aware of that, and we structured the lease around it whereby we actually took second floor office footage and mothballed it perpetually. So it was a loss leader, never generated any revenue, wasn't part of our exit cap because it was effectively losing money. We paid insurance, real estate taxes, paid to heat the space, but we forever assumed that we would never get any sort of dollar either on cash flow during the interim years or exit value on the back end. And as luck would have it, our next buyer and ultimately our tenant did value that space. But it allowed us to create a natural margin of safety, whereby if things were to go bad, we had that insulation, right? We had that buffer zone. And, similar to the concept of, no one to buy, no one to sell, we added that value through the lease itself, and we got out shortly thereafter. So that kind of got the snowball rolling down the hill. One deal led into another deal, and we expanded our team on a regional basis. We really kind of leaned in to research markets, trends, demographics, and the COVID years were crazy. But where other people were sitting on their hands, worried about the world falling apart, we saw opportunity.
Yeah. And our performance, throughout that period was outstanding, right?
Yeah.
But it's something I've noticed too, and we'll talk about life sciences here in a little bit, but something I've noticed sitting in investment committee now as we start looking at more very opportunistic deals in the life sciences space and kind of going back to that COVID time period, it's easy to sit here and say, like hindsight was 2020, like, oh yeah, we should have been buying, with both fists.
Yeah.
But it was a scary time. So I guess, how do you maintain conviction when everyone is running around with their head on, with their hair on fire? So
yeah.
What was that decision? Like, what was that conversation like? Like, we need to be buying right now. This is all going to work out.
Yeah. I think the past is a leading indicator for what the future can be. We're optimists at the end of the day. And, when everyone's running for the exits, generally a good time to buy, right? Very fundamentally. And what we were buying were assets that had staying power. They were in very good markets, very good submarkets. They had fundamentally good attributes to make them quintessential good real estate. And, got to focus on location first and foremost. They weren't going anywhere, barring a landslide or a tectonic plate shift. So our point of view was buy, underwrite appropriately, right? We had longer hold periods then. We had longer downtimes underwritten, right? Bigger general vacancies, lower rent growth, if any, and tempered face rents in the first place, right? We took that fear and the point in market cycles into account in the numbers. So if we banged up the assumptions and the deal still penciled well into a value add to opportunistic return spectrum of 15 to 20% IRRs, that felt really good, right? We knew that with a little bit of good luck in the sense of the genius scientists that created the vaccine and the world returning to normalcy, we would end up feeling pretty good about it. And obviously at the time, the market kind of had a way of solving risk, meaning lenders tempered their LTVs, right? So, and rates were obviously near zero then. So the leverage aspect of it, right? Most people, when they lose money in real estate, other than fundamentally making a poor decision about fundamental location, or screwing up something on the diligence end that was obvious, or, a known unknown, missing it. What happens in those situations is leverage bites you. And the time and place during that chaotic era, when a lot of people were sitting on their hands, the few lenders that did come to the table to get deals closed, they made it even safer, right? Just because they tightened their wallets. So it was a perfect setup where, on a risk-adjusted basis, even in that chaotic moment in time, it was very hard for us to fathom that in the long run, we would lose money. And it ended up working out very favorably.
You touched on being an optimist. And that's one thing I've noticed working, I've been in real estate for 12 years and working alongside a lot of deal guys. It seems like that is the one thing that has been consistent across acquisition guys. You have to be an eternal optimist to a certain extent. So I guess now that you manage our acquisitions team, how do you help counterbalance that, right? Because, sometimes people can be overly optimistic, right? Which can lead to aggressive underwriting. And so how do we manage the other side of that at Lightstone?
Yeah, I think we have a very good process in place, right? Some people are offense, some people are defense. You need that natural friction. It's healthy. Without that, you have yes men in the organization, right? You don't have checks and balances that make the system work. We're not afraid to pitch deals. We're not afraid to say, this doesn't work for these reasons without offending people. When there's a disagreement, right, we do what's called deterministic scenarios. Like, we'll have a very specific page within our investment memos that say, here's what happens if XYZ goes right, and here's what happens if XYZ goes wrong. And the truth is oftentimes in the middle, obviously, but all those perspectives are taken into account when we make the investment decision. When there's a major lease to be signed, a major decision to make, a refinancing to happen, or a prospective, sale opportunity, acquisitions works in tandem with asset management, with our C-suite, right, with our ops folks. And it's a team effort. It really is. So when you ask, how do we handle, underwriting assumptions that may come in aggressive? Well, the reality is that optimist, that whole team, you do need to come in initially on that first blush with the best desktop analysis you can do, right? And oftentimes that limited information tends to skew more towards the optimist angle. But I really believe that real estate will continue to be a people business. There's only so much that online data sources and AI can get you. Nothing beats boots on the ground, becoming masters of your own domain, asking the right questions, being inquisitive in general about the process, and talking to human beings that are in that market for decades.
A question we get a lot is we play in a number of different sandboxes, right? We own 25,000 apartments, 12 million square feet of industrial. I'm building a sizable life sciences portfolio, 5,000 hotel keys.
Yeah.
Question we get a lot is, so how do you know when to, shift your focus, right? So let's say that we're focused, obviously we still like the multifamily space a lot, but there are parts of the multifamily space we're not playing in anymore. Conversely, we are becoming much more focused on Chalabay Bay industrial real estate and life sciences space. So how do we think about that? Is like, what are we looking at to make that helps us inform that decision?
Yeah, I think when we look at investing from a very boiled down kind of pure 101 standpoint, and you're looking at verticals and you're looking at where do you want to throttle up, where do you want to throttle down in terms of capital, time, allocation of resources towards these deals, we like to kind of look at what will it take to hit our goals, both from a deployment standpoint and from a returns dynamic standpoint. If the only way you can make money in multifamily is with continued rent growth, crazy insurance premiums not going up like they were in the last couple of years, getting lucky with real estate taxes, right? And hoping and praying that interest rates and cap rates work in your favor, right? And if at any point in time one domino is out of place, it all falls apart. If that's what it takes to get from point A to point B and hit our goals, that's not the kind of business we want to be in, right? Too many moving pieces, too many what ifs, right? We like to simplify our investment strategies. We like to take what I call luck out of the equation. So when you ask, how do we decide to get into XYZ business or focus more attention to one vertical or another? We look at those risk-adjusted returns, right? What is our addressable market? How are we going to achieve our investment goals in terms of capital allocation? What's our geographic focus? How are we going to actually physically get our teams to the properties, diligence these assets, and handle the operating business to come, right? All this is taken into account. It's almost like a series of startups within our overall real estate umbrella. And, it's very clear to us when you lay it all out and we sit in our acquisitions meeting and we've kept our ear to the ground on multifamily. We've selectively bought. It's just a lot thinner of an atmosphere up there. It's clear to us that certain sectors are much more attractive at any point in time than others. And that doesn't mean we abandon the other verticals. It means we stay in the market. We remain active participants because you never know when opportunity strikes. And if you're not in the game, right, you're looking from the outside.
Buying distressed assets has been a big part of Lightstone's history.
Yep.
So kind of looking at the world today, life sciences is a sector we're very excited about internally.
Oh, yeah.
Why not office? Why not just standard office? Why life sciences? Obviously, cap rates are 10% and across both strategies right now. Why one or the other?
Yeah,
the other.
It's a very good question. I think there's more that lies behind the numbers. What I mean by that is there's incentives. There's this concept of people not only falling in love with deals, but feeling remorse, feeling that they're at fault, feeling attachment and not letting go. So a lot of these companies are sitting on these bad loans or bad bases on properties, extending and pretending. And getting to malls, when the leasing guy has to hit, $40 triple net rents and the market's at 20, and they can't get paid their incentive bonus unless they clear that hurdle that's originally set and it's not recasted, right? And they know that their owner that they work for is massively underwater and it's a death spiral. They're not going to be too excited about going to work each day. And they're not going to be motivated, right? Motivation here. Everyone's in this business to make money. Obviously, I'm here to make friends and have an enjoyable experience along the way. But we're here to make money, right? So with that dynamic, you then create a second layer, right? Another derivative of that. The tenants now know, they're not stupid, right? That the landlord is in deep trouble and they're not going to commit. They're not going to sign long-term leases when they know that you have an absentee owner effectively. The paint's chipping, the lights aren't replaced, the parking stripes aren't there, the curb appeal's gone, the grass is overgrown, and there may be a couple of vans here and there parked in the parking lot, literally siphoning the power from the facility, which we've had multiple times in our properties. And that, I think that's a leading indicator for a good deal. The deck needs to be reset. You got to shuffle it, you got to cut the deck, and you got to deal the cards. And those phase cards come out first for the ones that come into the game. So what we love about life sciences, now kind of connecting the dots for you, is that those same elements exist, right? You have people that are in for $500 a foot. You can buy that same property for $75 a foot today, right? That's exciting to us. That's true blood in the water. And there's very few bidders, right? People don't have that expertise and operational knowledge to handle those deals. It's highly technical. It just so happens our head of life sciences used to serve on a nuclear submarine and has an unbelievable engineer's background, which really, and decades of experience in the sector, gives us that purview and that ability to have high conviction bets and know what it's going to cost to rehab these buildings, know what it's going to cost to get that tenant in place, right? We're coming in a sector where people are fleeing. They're running for the hills. They're finally starting to crack and they're finally starting to dispose of these assets. The extend and pretend game has ended, and we would love to be the ones that take someone's trash and turn it into treasure. And we've done it several times over very recently. And, we're excited to continue to find unbelievable risk-adjusted opportunity in that space.
Yeah, so that's really, I would say, our focus on the opportunistic side of what we do, right? But we also have a lot of conviction right now in industrial.
Yeah.
So let's peel back the onion a bit on industrial because it's a very broad asset class. I think Most of the time when I'm speaking with someone about industrial, people think about your Amazon fulfillment centers, the million square foot bombers,
Yeah.
With the robots zipping around and delivering packages. That's not really what we're doing, is it? That's not where we focus.
No, quite the literal opposite. We found our niche in more of that shallow bay product. And, traditionally, the way I describe this, for those that are not in the know, it's effectively the apartment style segmentation, right? And investing world of industrial. Multi-tenanted, you have different options. The specific suites within shallow bay have different price and renting characteristics. You have to take everything into account and price it accordingly, right? It's that hard work of getting to that granular level of specifically taking account of each suite, which has air conditioning, which doesn't, which has a good new generation office, which doesn't, which has ugly carpet, which doesn't, right? You need to really get to that level of granularity. And where people make the mistake in the sector is they nonchalantly just throw $1 per square foot assumption at everything, a renewal probability at everything. That's just not how the real world works. We like to put ourselves in the shoes of the tenants and imagine if I was up for renewal or if I was shopping for space in the market, where would I go to, right? Here's what's available in the market. What would I pay for this space versus that space? And it's a role-playing game at the end of the day to figure out these numbers, and it takes a lot of work to get there. But what we really like about shallow bay is it's kind of the best of both worlds. But you have turn. Typical leases are 3, 5, 7 years. Sometimes there's outliers. You get a bite at the apple, right? The rents per square foot tend to skew up on a higher percentage, beating inflation on a CAGR basis. Why? Because you're talking about a couple bucks a foot and a couple thousand feet. Your tenant is keenly aware of what they're willing to pay and what is fair. But in the end of that day, when you look at the total chunk price, it can move a good amount as a percentage basis, but not really hit their bottom line. So it allows us to have that price appreciation vis-a-vis rent growth being outpacing inflation. Then you couple that with the natural, recession resistant. I wouldn't call it recession proof, but the recession resistant businesses. Our thesis is much more driven towards where is the labor, right? Where are the vocational graduation rates highest? Where are those vocational schools in general? And where are these tradesmen located? Where do you find that talent? We are very methodical about picking that location that's the best of both worlds. You're hitting the suburban, exurban core of growing, pretty affluent neighborhoods and all the demographic trends with wind at your backs. And you have that labor force to attract tenants to hire and build their businesses. And when you hit critical mass, economies of scale, kind of Econ 101, you are able to retain your tenants, right? The guy that has his pickup truck that's starting his business with a 1,500 square foot suite, we hope and pray that he grows, right? That's the American dream. Maybe one day he'll expand, tear down that wall next to him, keep on growing and growing, growing like an amoeba. And next to know it, we have a quasi-regional credit tenant that has an amazing success story that's expanded, right? And we've grown with him. And they become more sticky to the space. We have a more reliable source of kind of tenant income, recurring revenues, and we're adding value along the way. And they win too, right? It's a great symbiotic business to be in. And we love it, right? You're not just reliant on one specific credit, one industry, one tenant. You have a diversified kind of roster, no different than someone in an apartment building would have a lawyer, a doctor, a teacher, et cetera, et cetera.
Why do you think managers shy? Because when you look at a lot of the development activity that's happened in industrial, it hasn't really been in the space. Why is that? Is it because private capital or institutional capital, they don't want to manage 30 tenants with mom and pop type of tenants and independent businesses as opposed to the Amazons of the world? Is that what's driving that?
There's a premium to our business. And the reason why there's a premium is because there's that embedded, high touch management. If you are a private investor and you want to put your money out on a triple net single tenant deal, and let's just say a fund manager is charging you above market fees, heavy promotes, et cetera. And what have they done? They convinced you to invest their money day one. And then what did they do? They left all the way to the bank and sat on their ass for the next 10 years. You don't need that person to be that intermediary, but you sure as hell need us for a shallow base strategy because it is a constant ringing register operating business. Tenants move in, tenants move out, right? There's leasing, there's upgrades, there's parking, there's paving. Smaller spaces, more movement, things get banged up. But it's a management intensive business. It's not something you could do as a fly-by-night operation. You can't be a doctor, a dentist, or lawyer and do this in your spare time, right? Unless you're an octopus. Right? Maybe there's an agentic AI that could handle all of it, but I doubt it, right? This is exactly why you invest with a seasoned operator, because they will show you the way and they will do that hard work for you to unlock that value.
Well, and it's also, to your point, I mean, I know part of our strategy is, clustering, right? We don't want to buy just one asset in one market.
Yeah.
If we're going to own, like for instance, Louisville, Kentucky, a market that we're starting to break into, Austin, Texas, we've acquired and looking to acquire more.
Yeah.
Greenville, South Carolina. So can you talk to me about the importance of multiple properties in the same market like that?
Yeah. I mean, it's a classic economies of scale story, right? You have leasing people, you have operational folks, their salaries spread amongst more tenants, more buildings, more footage, right? You get the flow through. It's econ 101 to an extent, but from a human level, knowledge is power, right? We drill down to the point where Thanksgiving comes along and some of these tenants will shake their hand and give them a turkey, right? It's a true people business from that perspective. And once you are in the market, once you are ingrained in the brokerage community, once you're following the Chamber of Commerce, you're dealing with the mayor in some instances, you're looking at the zoning board appeals and you're seeing what's getting built, what companies are coming in. You're able to have a much more thoughtful, programmatic eye for investing. You're armed with so much more information, and that knowledge allows you to make more informed assumptions in your model. It allows you to, frankly, in situations where a market may be turning for the worse, know when to get out ahead of time, right? It cuts so many different ways. And now, case in point example, we own an amazing piece of real estate off the tarmac in Austin Airport. And you zoom out, you see this behemoth of a building. What is that building? It's a Tesla Gigafactory, right? It's a monster. And a lot of the businesses in our building are there, right? Part of our investment strategy is, and obviously Abernathy Industrial Park, you have BMW. If you are one of these tenants, OEM supplier, you're in that world, in the orbit of some of these major manufacturing hubs. If you're not located from a just-in-time kind of assembly line delivery window, these guys have a finite window each day where their product gets on the line. Barring, Jetsons type drones and personal, airplanes, helicopters, etc. You just can't get this product there unless you're in the right location. Traffic exists. We've all been there. And that's everything, right? We have tenants that are there because they have to be there, not because they want to be there necessarily. They can't go to the competing property 5 miles down the road because they can't get that contract with BMW or Tesla if they are. So that's another part of our strategy, that when you're in the know and when you're in the weeds in these markets, you find these things out and you put the real estate angle aside for a second. You get the kind of human nature and broader commerce angle of connectivity, literally and figuratively, of how the operations of our businesses that are our tenants interact with their greater ecosystem.
So let's shift gears a bit to the market today.
Yeah.
So I was reading a piece from chief economist over at BGO Asset Management, Ryan Severino, and he's calling, I thought he had a great word to describe what this next cycle could look like. And it's the golden age of asset management. Because if you look at returns really over this previous cycle, what we saw, I guess to take a step back, when you look at the attribution of returns in private real estate over the last 40 years, what I didn't realize was across most vintages, income made up the lion's share of returns. The big outlier was in 2010 through 2019, where capital appreciation made up 70% of the overall return because you had structurally falling interest rates. So essentially what that meant is if you were a manager and you bought a property, let's say you bought a property and you plan to raise rents, 300 basis points or $300, and you're going to improve the property and put some dollars into that renovation project. Because of the dynamics of the market at the time, managers could, improve the property. And let's say they got no uplift in rents. What likely happened is cap rates probably fell over the course of that period. So a lot of people's mistakes were masked by multiple expansion and cap rate compression.
Yeah.
Those days are probably over now, right?
There's no free lunch. There's no easy way to make money anymore, right? And I think the market has evolved. The tools that your average investor has access to in terms of primers, they could type in OpenAI, how do I make money, industrial, where are the good bets, where are the bad bets? It'll give you some of the answers. It won't give you the nuance. But, my view of the market on a go-forward basis, you want to do the deals that you want to do. You don't want to enter into these behemoth kind of blind pool funds and play the trust me game. It's not about the individuals in those blind pools being dishonest or being motivated by some ill will or something nefarious. When you have a mandate and a charter and you have a capital deployment window and you have to put that money out and you have a buy box, the money's burning a hole in your pocket and you need to deploy it. That's the mandate. That is the prescribed. You're on the roller coaster. Here's the ride. Starts out like this, loop-de-loo, then you're at the end, you want to vomit. That's what the experience has been for a lot of people in these kind of trust me, closed-end, funds of full discretion. The beauty of what we do and the way we're structured, we do deals that we want to do when we want to do them. Similarly, with Lightstone Direct, those that choose to join with us in these investments will have that deal-by-deal discretion. That is where money is made versus kind of riding these cyclical bets of interest rates and cap rates and kind of macro tailwinds or headwinds, right? We're not going to get everything right, but we're going to get almost everything right. Is what I'd like to say. When you have decision-making power and you see so much, and we have such a funnel of deal flow, we have such talented people across all of our verticals, and our origination efforts are, best in class. When you see everything, you have the ability to pick and choose what you want, right? The market moves, the signals are there for us to make decisions, and we could do it on the fly as we see fit, right? We're not forced to do anything. We're not looking to invest above some sort of internalized yield, and we're not mandated to put money out for the sake of putting money out just because it's above some fictitious line in the sand number that works for our platform, right? And I think that's the beauty of what we've created here. It's a real private enterprise that has ability to pivot, right? If we see something, we say something. And one day we could be gung-ho life sciences, and the other day we could be gung-ho multifamily, right? We see these patterns by keeping our ears close to the ground, and we're not afraid to use our talent across verticals. We have a lot of very specific subject matter experts. We have what I call floaters within our team that have become masters of multiple domains. And we're able to take advantage of that human capital that we put together here and our amazing balance sheet, our SOPs, our great lender relationships, and act when we see a reason to.
Yeah. Well, I remember when I first joined Lightstone and you and I were talking, and I think I came from a fund manager for this, and I was like, why don't we raise a fund? I remember you said to me, John, like some of the best deals I ever did were buying from funds.
From some of the most sophisticated, most institutional blue chip names you can imagine. I won't name them.
Yeah, but can you talk about what is it about those fund dynamics that creates those types of opportunities?
You have the fund docs. You have major decisions, minor decisions. You have capital calls. You have sunset provisions or extensions. But in the end of the day, when you have so many disparate investors with different motivations and you want to take things to a vote, the reality is if you were a closed-end fund and your fund was sunsetting well into that kind of COVID craziness period, right? Early on in that March, April, May, when no one knew what the hell was going on. And you got to sell, you're a forced seller. You just work your ass off for 5 to 7 years to get royally screwed by just rolling the dice in a bad way and having complete and utter shit luck, right? I don't want to work in a world, right? Or work for a structured platform whereby you're forced to do something that's so illogical and frankly asinine. No one involved in those funds actually wants those decisions to happen. But the charter, the way they're structured, and the votes and the dynamics at play, they are what they are, right? There are mechanisms, but oftentimes they, in turn, it's a double whammy because they take out CMBS. So now you've chopped up your equity stack to a bajillion pieces, and you're dealing with a lender that has chopped up their loan to a bajillion pieces, and there's no sheriff in town, right?
Yeah.
The lights are on, but no one's home, right? And you're kind of stuck. You're stuck in the mud. So one of the best deals I did in my career was, I think it was a 15 hotel portfolio in Ohio. And we bought from one of the most sophisticated top 4 institutions in the world, honestly. When we bought from them, we stole the property because they had a looming refinancing and they couldn't raise the proceeds to pay the extension fees and kind of those refi frictional costs. And we bought it some ridiculously low number. If my memory serves me correctly, I think it was 50-ish thousand a key, give or take. 18 months later or so, we sold it for 110, 115,000 a key. And we got a good cash flow along the way. They didn't sell that because they didn't think there was incremental value. They sold it because they had to, right? So you just don't want to be on that boat, right? It's like the boat sinking. You know how to swim. There's a lifeboat that you could press a button and deploy it, but you're like willingly going down with the ship. You're not even the captain, right? There's no honor in that. So yeah, that's my rant on, there's Antifa and then there's anti-funds. I'm an anti-funds guy.
Yeah, well, and it's interesting because then on the other side of the coin, you have, the semi-liquid private REITs that we see today. And, you have this massive asset liability mismatch. And I think that the problem that we're seeing there is that you're trying to make what is truly an illiquid asset seem liquid, right?
Yeah.
And that's just not the case. Like there's a cost for that liquidity. So to shift gears a little bit, let's talk more about what the next 12 months are going to look like, right? Before we wrap up. What's got you excited? What do you think? I mean, you see green shoots forming on the horizons. What are maybe some indicators you're looking at that would maybe change your opinion of what the next 12 months could look like?
When I look at the next 12 months in light of everything that's gone on, particularly just kind of putting the wars and very bad geopolitical things aside for a second, not getting political on that, just talking about fundamental implications of tariffs and some of the stuff coming out of Washington that's really created a pattern of indecision, right? Getting back to industrial for a second, when you're a manager of a supply chain and you're looking at a regional presence or national presence and you're trying to decide, where am I going to close a distribution facility? Where am I open? Where am I going to optimize my flow? And you don't know how tariffs are going to, impact business on a go-forward basis. Consumer trends with, interest rates really rising dramatically over the last couple of years. They're starting to temper, but it's pretty opaque in terms of what the next cuts are going to be. It's hard to make decisions, right? So what I'm hoping is that there's going to be more clarity, right? Once these kind of rules are set in stone across the board on the global trade end of things, the new paradigm will then take root. That indecision will, that will be broken, right? The impasse will be past us.
Right.
And people who are doing their jobs that are tangential to the real estate world will be able to make those decisions. And what we found to date, it's not like they're not making their decisions ultimately, but they need to be pushed a little bit, right? You need to incentivize the tenant with a little bit more TI than you anticipated. But the beauty of what I'm seeing in terms of the green shoots and my reason for optimism is that face rates are holding up. And why is that? Part of
By face rates, you mean rental rates?
Yeah, rental rates, just the base rent, triple net or gross. We don't get into those details, but someone's paying $18 6 months ago, they're paying $18 plus or minus today, right? If not more, right? It's going up a little bit to inflation, but it's not falling, right? That's the key. What's ultimately happening, right, when you look at this reorganization of the system with these new laws that are going to be put in place, and clarity is what people want. They don't want indecision. You have a net benefit of the chaos we just went through. What is that? It's that because the crisis of confidence, right, in the context of not being able to project so easily into the future, and the rising interest rates and cap rates in tandem, what did that do to the market? It stopped a lot of shovels from going in the ground and stopped cranes from doing their thing. So you have this pocket of demand that's been fairly healthy and continuing to grow. And then you have this supply shock of the overbuilding into the COVID craziness now tempering off. And in those interim years, you don't have a lot of new supply coming on board. So the dynamics are shifting, right? And once things stabilize in terms of tenants being able to make decisions faster and tenants in the market starting to get more frothy with lack of supply and more demand, it's really going to favor those that own product in good areas, right? Long-winded way of saying we're very bullish, right? We see what has been malaise in the last couple of years, to be frank, right? COVID years were boomtown in our world, and we were incredibly selective with our buys. There's something innate about knowing the market and knowing when to stop and just pull back. We generally remain very active no matter what, but there are certain times where you really need to stop. So that was that period. That's all coming out of the system now, right? All those bad deals that got done, all that kind of excess supply is now being absorbed. Positive absorption is taking root again. And without new shovels in the ground, without new product coming online on the horizon in the same scale, it's setting up to be a pretty good run here.
It's interesting. I think about this all the time. Like, what is it about people? I mean, but, companies are no different. When obviously valuations, we've seen valuations fall 20 to 30%, and the opportunity set, as you just laid out, so elegant. Why do people still like to chase what's hot, right? As an example, whether it's data centers right now, which is an incredibly crowded space. I mean, we like data centers as well. I mean, but why do you think people like to still chase, whether it's tech or frothy valuations as opposed to what seems obvious when you step back, which is, go to like something that we've done consistently for 40 years, which is we want to go to the beaten down sectors.
Yeah. It's just a lot easier to be a follower than a leader.
Right.
It's human nature. There's the human nature element of this business and many others cannot be understated. No one's going to get in trouble for following the herd and doing the bet that XYZ group made, right? If your peer group and your competitors did something and you basically followed suit and the bet went sour and the market fell, it was this, it was that. And it's not my fault. I was following the trends, right? I think a lot of it's plausible deniability.
Yeah.
A lot of it's just lack of getting out of the comfort zone. It's the easy path to take, just to follow the herd, to be the lemming off the wall.
Yeah. It's almost like I think it's, for me, it's got to be a combination of an element of complacency, right? Like if it ain't broke, don't fix it.
Yeah. The music eventually stops.
Yeah. And then, I think about when I try to go against the grain, and then I'm like, well, if I'm the only one doing this, I must be wrong. It's like not having enough confidence and conviction in your own ability to make decisions.
Sometimes the market speaks louder than all of us, right? There are times where there could be a quick buck to be made in those situations. I would go back to our kind of COVID exits when we saw that someone was paying year 10's projected price. Okay, see you, property. Here's the deed.
Yeah.
Can't sign it fast enough over to you. Yeah. It's just having that natural ability to just see it as it is and move with conviction in either direction, buy or sell.
It's a final question, I think, is imagine you're sitting here, you're talking to a relative, and they say, Sanford, I like you guys, but I want to vet a bunch of other real estate managers. What should I do that? What should I ask them? Right? What tips would you provide to any of our listeners or anyone watching this, or maybe evaluating real estate for the first time, don't know what to ask a real estate manager, don't know how to vet a property? Like, what would you, if you had to give them a list of 5 questions or just pieces of advice, what would you tell them?
I think first and foremost, you want to know their resume, very simply. And when I say that, I don't mean just what school they went to, how many years they worked at XYZ. If someone is acting like an acquisitions person in a role, say they left their company, they're 33, they have high hopes to be an entrepreneur, but maybe they were in asset management or a finance department for 10 of those years, and now all of a sudden they're buying a property. The shoe needs to fit. I'm not disparaging other parts of the business, but you need to know what you're getting, right? If you're looking to invest in new deals, you want to be talking to the person that actually buys the deals, right? You want to know that they have the breadth and depth of experience to roll with the flow, just to see what, is out there in terms of the lava pits. You ask them what can go wrong in this investment and you hear their answer. And it'll be very telling if they feed you a bill of goods and say, this is recession proof, this is bulletproof. No, things can go wrong. And I'll paint that picture for you, what can go wrong. I think it's a low probability of this happening, right? But, there could be some turbulence. And here's how we would act in the event of turbulence, right? You want to know in a high pressure situation how someone's going to behave. And you could look to the past precedent, ask them what was the biggest horror story they went through and how they deal with it. And then see if that is jiving with your investment ethos. Another thing that's kind of an obvious one for me, but for someone who's kind of looking into real estate in the private world and looking to make one of these investments may not know, it's not about how glossy their investment memo is. When you ask for some backup of a model, for instance, and you have these on a single line item assumptions, hard cost $300 a foot, soft cost $50 a foot, total XYZ. And it's back to the napkin math. And the numbers are perfectly rounded, exactly $300 a foot hard costs. Red flag. Run for the hills, right? It means that they didn't put the time and effort in to properly create a budget. And you wouldn't believe on a development budget, for instance, how many line items go in there, right? Another case in point example, hotels are the easiest ones to poke holes in because it's an operating business, right? Now, if I told you we had a guy on the payroll that's job is literally to wear an awesome 3-piece suit, be the hype man, be the vibe guy, and know exactly at the time of day when to stop shining those bright lights, when to dim the lights, and when to take that modern jazz music out of the equation and start putting in some actually good music to set the vibe, make that work. That exists. That is on our payroll. That is a person that's important. That's in the budget, right? Mm-hmm. You have to know people that are in the know, right? You have to find people that have the detailed answers. Don't give you snippy kind of one-word answers. That's going to be a true litmus test of, if they could both talk the talk and walk the walk.
Yeah, that's a good place to leave it. Sanford, thanks for your time. Thank you everyone for joining us. And we'll see you next time.
All right, well, that wraps up this episode of the Redirect podcast. Thanks for joining us and listening in today, just to hear a little bit more about how institutional real estate investors are thinking. So you, the individual, can approach capital allocation with some greater clarity and discipline. If you found today's episode at all valuable, we'd love to hear from you. Feel free to please reach out and provide feedback, share how you're viewing the markets, and start a conversation with John or I. To learn more about Lightstone Direct and our approach to investing, you can find us online at lightstonedirect.com or reach out to John and I directly. We will be back very, very soon with our next conversation.
The information provided in this podcast is for informational and educational purposes only and should not be construed as investment, legal, tax, or financial advice. The views and opinions expressed are those of the host and guest as of the date of recording and are subject to change. Nothing discussed in this podcast constitutes an offer, solicitation, or recommendation to buy or sell any securities or investment products. All investments involve risk, including the possible loss of principal. Past performance is not indicative of future results. Listeners should consult their own financial, legal, tax, and investment advisors before making any investment decisions.